The 20 should-dos when you are losing money in mutual funds. You know, mutual funds invest in the stock market. This exposes them to market swings. Market swings affect the net asset values of your units. In a bear market, you are tempted to redeem your units. But you know, a bear market is really a time for thinking, planning and strategizing. Should-do 1. Do not panic when the market falls, and do not rush to redeem. Should-do 2. Build an action plan on the cornerstone of patience. You know, staying calm is a necessity when markets swing. Stocks offer superior returns over longer time frames. In the short run, they swing. However, over the long run, losses average out. Alright, so should-do number 3 is to avoid redeeming in haste. You know, mutual funds can actually lose you money if you act impulsively. Now, should-do number 4 is to redeem only those funds that haven't performed for a long time. Seriously, don't lose more than you need to. And finally, should-do number 5, redeem funds that have failed to perform even in a bullish market. So, should-do number 6 is, well, to think doubly and consult experts before you decide to redeem. It's always a good idea to get a second opinion when it comes to your finances. You know, the cost of redeeming, even before completing a year, is actually quite high. It's something a lot of people don't realize until it's too late. And well, this is because such redemptions invite exit loads and capital gain taxes. So yeah, it's important to keep these in mind before making any decisions. Yet the thoughtless redeem when markets fall and reinvest when markets look up. That sounds good, but it is not easy to time the market. Should-do 7. Redeem only if you need the money for an emergency. So, should-do number 8 is, you know, decide your exit based on the criticality of your needs, and not just on the bobbing market. Should-do number 9. Invest smartly through systematic plans. It's honestly one of the best ways to stay consistent. Systematic plans, well, they pretty much take on themselves the job of timing the market for you. They ensure costs and losses are averaged out by giving you more units in bear markets. They eliminate the headache of tracking market ups and downs. Should-do 10. Ignore small negatives for bigger gains. Should-do 11. Start comparing the performance of your funds with similar funds. Find out whether the category as a whole is not performing or just your fund. Should-do 12. Invest only in mutual funds that enjoy high ratings. Should-do 13. Never ever invest in mutual funds with a short-term outlook. Should-do 14. When you invest in equity funds, be aware that equities can lose money. Should-do 15. Diversify across promising categories of funds. Should-do 16. Always research the category of funds you're investing in. Should-do 17. If you are losing money, find out where you are going wrong. Course correct at once. Should-do 18. Check out whether you are diversified enough. Lack of diversification is why you lose money often in mutual funds. So yeah, it's really important to diversify across fund categories, fund companies, and even fund managers. Should-do number 19. Make sure you spread across different market caps. And, you know, add some debt liquid funds to reduce your equity exposure. Should-do number 20. Finally, always have a long-term outlook. But hey, that shouldn't stop you from reviewing your funds periodically.